Hey guys, I am Paul and today I want to talk to you about what makes the stock market move. The goal of this video is to help you understand the five major factors that influence stock prices so that next time you see the market move, you'll better understand what's going on and hopefully make more informed investment decisions. I've seen this week the stock market can be a crazy place, place and that scares a lot of people away from investing but ups and down in downs in the market are normal. Nothing goes up in a straight line, so it's to be expected. The key is to take the emotion out of it and keep a cool, calm head and position yourself to weather any market downturns. I am gonna explain the five major factors that move that the markets when the stock market is going up or down. You can be sure it's due to on due to one or more of these five factors. The first is interest rates. The stock market has been on a major winning streak since 2008, making record heights and making a lot of people rich at the same time. Interest rates have been at their lowest levels in history, close to zero. This is not a coincidence. When rates are low, that makes it easier for people to buy things on credit for companies to finance new project creates jobs, and there's just more cheap money for everyone all around. This helps the economy, which in turn helps the stock market. So in general, low interest rates are good for stocks. High interest rates are bad for stock. Interest rates in the USA are set by the Federal Reserve (AK). The Fed meets 8 times a year, and markets move in anticipation of what it expects the Fed to do at these meetings. So if the market thinks the Fed is going to cut rates at the next meetings, markets will rise. And if the market think the Fed will raise rates at the next meeting, the market will drop. Of course, it's not always black and um, white like this, because there's other factors in play, which bring me to the next factor: quantitative easing. Quantitative easing is just a really fancy term of printing money. Since the Fed controls the money supply, it can also literally print more USA dollars at will back in a day. This meant actually printing process will print more USA dollars nowadays. It all happens digitally. Remember how I said the stock market has been on a major winning streak since 11 years, will in education to keeping interest rates super low around. This time the Fed uh, has also been printing trillions and trillions of dollars. Hence the term quantitative easing, and this boosts the stock market in a major way. Why? Because printing money increases the amount of money and circulation, so there's lots and lots of money that needs to find a home, and all this money is getting pumped into the stock market. And other kinds of assets driving prices up the next factor: geopolitical, how to pronounce it anyway. We live in an interconnected world, so things like natural disasters and earthquakes in other parts of the world, war, international relations, diplomacy, what OPEC is doing about oil prices. All these things have an impact on stock markets. So things like Trump's trade wars with China, nuclear war threats from North Korea, the 9/11 terrorist attacks, all these things cause uncertainty, uncertainty, and stock markets don't like uncertainty, so headlines like this can often cause panic selling and quick big drops into market that later reverse just as quickly. So geopolitical events can often be opportunities to buy stock really cheaply. Another factor is human emotion. Just fear and greed, and we're all guilty of this. Sometimes markets just go up on. Poor, poor speculations grants even though there isn't really any economic growth or data to back it up. There's always gonna be some idiots who's willing to pay a lot on the, the hopes that another idiot will come along willing to pay even more. Bitcoin is a classic example of a speculative market. Prices go up like crazy, just everyone thinks they're gonna get rich overnight, and these speculative bubbles burst just as quickly. We all know what happened to Bitcoin prices this year. The flip side of greed is fear. The market can drop really quickly when everyone is scared, panicking, and the attitude is just sell. First, ask questions. Later, you never want to sell your, your stock at times like this, because it's always gonna be the worst possible moment. Panics are always temporary, so you want to let the market come to its senses, let prices recover before you make any big decisions. The 50 and final factor is economic growth or the lack of it. Stocks are pieces of ownership in companies, so when the economy is growing, that means company sales and profits go up, and that makes stock prices go up. If the economy is slowing down, that means less spending, less jobs, lower company sales and profits, and those lower stock markets is directly linked to the growing and the shrinking of the economy. So how do you know if the economy is growing or not? The answer is by looking at economic data. The market reacts to data relations such as known for payrolls, unemployment rate, GDP, retail sales, and a whole lot more, but I just named the most important. And the best way to stay on top of data releases is to use a website. I like Forex Factory. Come and you can stay on top of what's coming or out each week. So there you have it. Now I have a question for you. What's the most confusing part about investing for you? Let me know in the comments below, and let's get this discussion going. Please share this video so that we can empower even more people with the financial literacy and courage they need to live on their terms. Thanks for watching, and I will see you in the next video.